This is an important video, so let's just jump right in. So what is this potential economic crisis that I don't think enough people are talking about? It's the dramatic slowdown over the last 12, 13 months of manufacturing in the United States. We've just gone through 13 months of slowdowns and things getting worse for manufacturing. In fact, as I report this, there's a big survey that's called the Chicago PMI. It just came out a couple days ago. PMI stands for the Purchasing Managers Index, and it's a measure, it's a survey of people that work in manufacturing, that are ordering goods, ordering services, that are on the front lines and know what's going on in manufacturing. And a number above 50 is good. It means that things are growing. And unfortunately, for the last 13 months in a row, not only have things been getting worse, they're below 50, but the number has continued to go lower. And in fact, as I record this, there was just a huge miss. The number was 36.9, and economists were expecting a number of 43. So why should you care? Again, above 50 is a good sign. It means things are growing. Below 50 means that things are slowing down. Again, 13 months in a row below 50. And frankly, a value of 36.9 is horrible. Now, why do I say this? Since the Chicago's PMI inception in the 1970s, a value of 36.9 is below the level of the index was at for the start of 6 of the last 7 recessions that the United States have gone through. Candidly, this is a big miss for manufacturing, and it's happening at a time that we're also worried about a slowdown in retail and a slowdown in service. Now, the good thing about the United States economy is manufacturing is not the big dog in our country anymore. The big dog, frankly, is consumer spending. Consumer spending represents 70%, 70% of the U.S. economy. But what I'm worried about is there are a lot of good paying jobs in manufacturing. And a number like 36.9 leads me to believe, I don't know, this is not my area of expertise, but I do know for me it's a warning sign. And what I'm worried about is manufacturing companies are going to increase the pace of their layoffs. They're not going to be giving people raises that will keep up with inflation. We've already seen that the labor shortage that we saw coming out of the pandemic, that unfortunately for workers has quickly subsided. Gone are the days where people were getting signing bonuses and getting healthy raises. And we're now seeing contraction in the amount that people are getting raises for. We're seeing an expansion of the applications for new jobs. And unfortunately, we're seeing more and more layoffs in 2022. A lot of that was in the tech sector, and now it's expanding. And we all know that the Federal Open Markets Committee, Jerome Powell, is trying to avoid a recession, right? I'm doing this because he's trying to fly this airplane into a soft landing. And in many ways, it seems like we're really, really close to getting there, right? In my opinion, we've had what I call a rolling recession. So we haven't officially triggered a recession, but clearly there's been different pockets of the U.S. economy that have been slowing. And I would argue within different sectors there has been a recession, but overall the U.S. economy has remained healthy. Unemployment is low. There's a lot of good things happening in the economy, but what does this mean for our investments? What does this mean for our retirement savings? Right, the stock market is not looking backwards. The stock market, I should go this way. The stock market is not looking backwards. The stock market is looking forward. And so we all have to think, what's happening in the future and what does this mean for you? So that my views are coming up with a long-term allocation for your investments is the key. What percent of your portfolios in stocks? What percent of your portfolios in bonds? And the reason I'm kind of sounding an alarm here is it's just natural after a year in 2024 where the S&P 500 was up over 20%, second year in a row that we've had 20+% returns. It's natural for us to get in front of our skis, to drift away from our long-term allocation. And having a good long-term allocation, a portfolio that has enough stocks that you're capturing the upside that you need to beat inflation over time, but not so much exposure to stocks that if something scary happens, if there's a 20%, a 30% or more correction in the stock market, not so much exposure that we're going to panic, frankly, that it's going to cause not just worry, but it's going to cause angst and anguish, and people won't be able to sleep at night because of the worry. And that's when people, unfortunately, become forced sellers in a down market, even if you're not retired yet. That mental angst that keeps you up at night, that makes you worried. If you've, let's say you've got a $500,000 portfolio and half of it is in the stock market, that's $250,000. So a 20% correction is $50,000. Now, I want you to think about that now, right? A 50-50 allocation for stocks if you're not retired yet. I don't know your situation, but that's not abnormal. In fact, it's probably a little conservative for somebody that's working now. But if those numbers are close to your situation, or run your own numbers and just make sure that if in a 3-week, a 4-week period, the market were to drop 20, 30% or more, that you're okay with that. One of the things I like to tell my clients to do is write on a piece of paper. Okay, let's give me easy math. Let's say you've got $1 million portfolio and half of it's in stocks, $500,000. The market drops 40%, you just lost $200,000. So put in an envelope, instead of your $1 million portfolio, now you have $800,000. How do you feel about that? If you're married, how do you and your spouse think about it? And really internalize that. Think about how long did it take you to initially save $200,000. For many people, we were in our 30s or 40s until we had $200,000 saved. It's hard to save $200,000. And to see that disappear in 3 weeks, 4 weeks, or even if it's 12 months, that's painful. Now, the thing about the COVID drop, and if you made it through the COVID pandemic and you did not blow out of your long-term allocation, kudos to you. One thing, that was the fastest drop ever, which made it super scary. And none of us knew, could it have caused a depression? Might have, none of us knew. But the thing that made it less painful on the way out was just how rapidly the stock market recovered. We didn't have to wait 2, 3, 4 years until we got back up to even. In fact, by the end of 2020, the S&P 500 was in positive territory again. So yes, that drop was painful, but if you were working, it was likely less painful because you had new money coming in. You didn't have to sell likely if you were still working, you still had your job, you still had your salary coming in. And one thing to be careful about is as we get closer to retirement, as we get in retirement, that pain of loss can be much more painful, and not just a little bit more painful. I'm talking a lot more painful. 2, 3, 4, 5 times as painful as when you were working, because you can no longer dollar cost average in on the way in. In fact, you're on the opposite side of that equation. The evil cousin of dollar cost averaging is sequence of return risk. So you might be selling into a down market to fund your living expenses. So one thing you can do to protect yourself from, there's a couple things. One, make sure you've got that asset allocation right. I suggest you work with a professional to make sure you've got that right, either an accountant or, better yet, a fiduciary financial advisor. The second thing is, instead of thinking of your stocks and bonds as 60-40, think about how many years worth of living expenses do you have in your bond allocation. So let's say you've got $500,000 and you're 40% in bonds. That would be $200,000 in bonds. And let's say that you're spending, just for easy math, $50,000 a year as you're spending. You've got 4 years worth of living expenses. That can give you peace of mind if things do get scary. Another decision that's super important is thinking through when's the right time for you to retire. And that's why I made this video up here. Why waiting to 65 to retire might be a big mistake. You want to make the right decision for you and your family. And do yourself a favor, if you haven't watched this video yet, take a look at it, because you might want to actually retire sooner than what you were thinking of. And the video will tell you why. I'll see you in that one. Thanks for watching. Bye-bye.